Ipca Laboratories has been on the investors' radar as its key anti-malarial drug, hydroxychloroquine sulphate, was seen as a drug of choice to combat COVID-19. In our Ideas for Profit today, I will discuss about the sales growth of this drug so far, the other operating metrics of the company, and also if the stock warrants investors' attention also. Well, HCQS sales in the first 2 months of Q1 FY21 was upbeat as the company supplied 42 crore rupees worth tablets, that's 12 crore tablets for the state governments. However, in recent times, the research reports and also the regulatory actions have not been very supportive, and this has led to uncertainty on the near-term additional demand for COVID treatment as well. Now, recently, US FDA updated that HCQS has been removed from the list of drug products in shortage, and hence, US FDA has also taken away the exemption given for import alert to the company for HCQS. Now, as per ICMR guidelines, HCQS use is restricted to preventive usage for people with mild symptoms. As a result, demand prospects for HCQS has moderated, and the success in the first 2 months of the fiscal year may not get extrapolated. Having said that, what comes as a relief is that unlike its peers, the company was not required to really make additional investment for the HCQS opportunity. As a result, Q4 sales surged by 22% year-on-year, backed by the generics export, the domestic formulations, API partially offset by the decline in branded or institutional exports. Now, gross margins also improved by 91 basis points due to a favorable product mix. However, the reported EBITDA margin contracted due to the forex loss of 24 crores and the impairment charge of 28 crore rupees. That EBITDA margin also improved to 20.5% versus 18.7% in the base quarter. That's in spite of the higher employees' cost. Now, Ipca has been under US FDA's import restrictions for 3 of its manufacturing facilities as well. Now, here, the company is done with most of the remedial actions and also awaits the US FDA inspections. Now, as far as the R&D expense is concerned, it was 2.5% of sales in FY20. The management expects it to improve to 4% in the medium term if the US business comes back on track. Now, company also has capex plan of say 250 crore rupees for FY21, wherein about 70 crore rupees is allocated for the Devas plant. The rest of the capex includes solar plant for captive power consumption, Pithampur plant, and the automation projects. Now, Ipca's debt profile is quite reasonable with a debt to equity ratio of 0.13 times, and this provides scope for funding for capex programs. Now, for generics formulation exports, plants at Pithampur and Piparia are running at suboptimal capacity of about 25% and about 15% respectively. Now, in case of APIs, though if you look at currently there is a capacity constraint, but the management really guides for a 19% plus growth in FY21 for APIs. Even though HCQS opportunity has faded, we would like to see the business going forward for its increasing diversified business model. The company few years back was mainly known for the anti-malarial medications and now has a significant contribution from non-anti-malarial medicines as well. Now, also vertically integrated model is positive, which helps in better operational efficiency and also a control over the supply chain and improving margin profile. Now, as far as the stock price is concerned, it has recently consolidated in the broad range of about 1500 rupees to 1650 rupees after a strong run up in the calendar year. Now, stock is trading at a valuation of 16.2 times FY22 EV to EBITDA, which is a strong guidance, and subdued macro backdrop is also reasonable. Now, we do believe that any weakness in the stock price should be definitely utilized by the investors for accumulation for the long term.